Hi, today we are going to discuss another important topic in accounting, that is journal. In the previous four sections, we got a little idea about accounts, what will be the evolutions of accounting, what are the objectives of accounting, how accounting equation is derived from each transactions, how you will identify debit and credit. All these areas we discussed in the previous classes. Then, now the identification of the transaction is over. The identified transaction may be one aspect will be a debit aspect and another aspect will be a credit aspect. We have to record all the transactions whichever you identified, which as a debit and a credit, should be recorded in a separate books of account. That is why we are discussing another topic that is known as journal. The word journal is derived from a Latin word jor. Jor means a day. Simply we can say journal is a book in which transactions are recorded in the order in which they occur. The word journal is derived from a word jor, which means day. That means daily transaction recording book is known as a journal. All the organizations are preparing the journal. You have to record the transactions in a journal that is known as journal entry and journalizing. We have three terms in books. Journal is there. Look here. Journal is a book in which the transactions are recorded in the order in which they entered or occurred. Journal is a book of original entry. Journal is a book of original entry in which transactions are recorded in the order in which they occur. The transactions are recorded in the order in which they occurred. It is called book of original entry. Journal is otherwise known as book of original entry. All financial transactions can be recorded in a simple journal. In every business organization, there may be n number of financial transactions are there. Financial transaction means rent paid, salary paid, insurance paid, started business. These are the financial transactions. You are recorded all the financial transactions in a single or a simple journal. But if you want separate journals also prepared, we can prepare separate journals also prepared called special journals. We can prepare separate journal. For example, for the credit purchases, credit sales, return of sales, purchase returns, you can prepare separate subsidiary books. These are known as subsidiary books. Firstly, you understand what is the meaning of journal. Journal is a book of original entry in which transactions are recorded in the order in which they occurred. Journal is the most important book of any organization. All the financial transactions can be recorded in a simple journal. But we are preparing some special journals or separate journals also prepared for recording some transactions. They are known as special journals or sometimes we can call as subsidiary books. Next will be what is the meaning of journal entry and what is the journalizing and what is the posting. Journal entry means an entry recorded in the journal is called journal entry. An entry recorded in the journal is known as a journal entry. An entry, you are recording an entry in a book of journal, is known as journal entry. Then what is the meaning of journalizing? Another term. Journalizing means the process of recording transactions in a journal is called journalizing. The process of recording transactions in a journal is called journalizing. Journal entry, an entry recorded in the journal is called journal entry. Journalizing means that process recording the transactions in a journal is called journalizing. Then, after journalizing is over, you can transfer all the entries from journal to another important books that is known as ledger. Ledger. The transfer of journal entries to a ledger is called posting. Firstly, you have to do the journal. You have to write the journal entry. After the journal entry is over, you can transfer all the journal entries to another important books of account that is known as ledger. That process, the transfer of journal entry to a ledger is called posting. This is the introduction about a journal. Look here, how we can draw a journal. How we will draw a journal. Journal is firstly you can write the date column, January 1. What is the transaction? Which one is debit? You can write first the debit and second the credit. Then each transaction you are writing, you can give an explanation about each transaction. That is known as narration. For example, rent is debited. That means rent account debited. Cash you paid, cash. We can give explanation rent paid. Being rent paid or rent paid. You are paid 10,000. Therefore, 10,000 here and 10,000 here. Debit and credit, you can write 10,000. What are the columns in a journal format? Date column is there. Particulars column is there. Ledger folio column is there. Debit amount column is there. Credit amount column is there. Date column shows the date of the transaction. Particulars column shows which one is debit and which one is credit. And ledger folio column is normally used for reference purpose. Which area or which number is given for understanding. It's a kind of reference. Then debit amount and credit amount is always same, but the account is different. Look, on example I given, rent is debited and cash is credited. Rent is an expense, that is why debited, and cash is going out from your business, that is why it is credited. This is a simple example of journal entry. Then we can let us understand some examples of journal. For more clarity, you can use it. Look, I will give here 3 examples. A started business for rupees 100,000, purchased the furniture rupees 10,000, paid salary 300,000, 3,000, sold the goods to A 5,000. These are the just example for how to write a journal. Look, this is the format of the journal. You can write here, date column is here. This is particulars column. This is ledger folio column, debit column, and credit column. You can write like this format. First transaction is A started business for cash, 100,000. What are the 2 transactions here? One is cash and capital. Each and every transaction there is 2 aspects is there. Here we can see one is capital and the second one is cash. Cash is coming to the business. Therefore, it should be debited, or cash is increasing according to the modern approach. Whenever cash is increasing, it will be debited. Therefore, cash is debited and capital is credited. We can read as cash account debited to capital. Cash account debited to capital, 100,000. How the journalizing coming, you can check it. Purchased furniture for cash. 2 aspect is furniture and cash. Furniture is real and cash is also real. What is the rule of the real account? Debit what comes in. What is coming in the business? Furniture. Or modern approach saying asset is increasing, debited. Therefore, furniture is debit and cash is credited. You can write like this. Paid salary. Salary is an expense account. What is the rule of the expense account? All expense should be debited. Therefore, salary will be debited. Salary and cash. Sold goods to A. A means there is no cash. It is a credited transaction. Therefore, 2 aspects is there. A and sales. A means what? Personal account. What is the rule of the personal account? Debit the receiver. Therefore, A account debtor to sales 5,000. These are 4 examples to understand how journal transactions are recorded in the journal. Just for understanding purpose. Another small topic is coming. Discount. We are familiar with some kind of discount is there. In accounting, we can see 2 types of discount is there. One is trade discount and the second one is cash discount. Trade discount means the discount allowed by the seller on purchase of goods and services in bulk quantities. Whenever you are purchasing goods and services in bulk quantities, you will get some discount. This discount is known as trade discount. This discount is normally deducted from the invoice and you are getting only a net amount. You have to pay only the net amount of the invoice. Therefore, no separate journal entry is required because you are booking the net amount in the books of account only. That is known as trade discount. Trade discount is a discount which is allowed by the seller on purchase of the goods in large quantities. Whenever you are purchasing the goods in large quantities, the seller will allow a discount. That discount is known as trade discount. Trade discount is normally deducted from the invoice and you have to pay only the net amount of the invoice. Therefore, no separate journal entry is required for the trade discount. That means you are booking only the net amount in your journal. Therefore, no separate journal entry for the trade discount is there. Second one is cash discount. Normally, all the organizations are allowing cash discount. When you are giving a cash discount, when the prompt payment or we can say early settlement is given, at that time one person is allowing another person a discount, that is known as cash discount. The allowing person is recorded as discount allowed. The receiving person recorded as discount received. Look here, cash discount means it is allowed by the seller to encourage early payment. To encourage the early payment. You want to encourage it because early payment. If a person is settling the money early, at that time the seller is allowing a discount. That discount is known as cash discount. The person who is allowing the discount is known as discount allowed. The person to whom the discount is received is recorded as discount received. These are the two terms. One is a trade discount and the second one is the cash discount. Another small topic is coming in this chapter. One is opening entry and the second one is compound journal entry. Sometimes you have to pass opening entry and you have to pass compound journal entry. Therefore, we have to clear picture about why an opening entry is passed. How a compound journal entry we can write for that one. An opening entry means an entry passed at the beginning of the year. An entry passed at the beginning of the year to bring down all the assets and liabilities from the previous year to the current year. An entry passed at the beginning of the year to bring down all the assets and liabilities from the previous year to the current year. Whenever one accounting year is closed, there may be some assets and liabilities will be there. Because all these assets and liabilities are lying in a business, you have to bring down in the books of account all the assets and liabilities from the previous year to the current year. Therefore, you have to pass an entry. That entry is known as an opening entry. An entry passed at the beginning of the year to bring down all the assets and liabilities from the previous year to the current year is known as an opening entry. Number 2 is compound journal entry. Sometimes same date, more transactions are coming. If we can write journal entry, some journal entry as a compound journal entry, some journal entry, or an entry which has more than one debit, or credit, or both. More than one debit or credit or both. Suppose you are checking one journal entry, there may be more than one debit is coming. For example, salary account debit, rent account debit to cash. This is a compound journal entry. Some journal entry can see more and more debit and more credit in one entry is coming. That journal entry is known as a compound journal entry. First one is opening entry, an entry passed at the beginning of the year to bring down all the assets and liabilities from the previous year to the current year. And the second one is a compound journal entry, an entry which has more than one debit or credit or both is known as a compound journal entry. We know that business is always linked with the bank. Because most of the business organizations always n number of banking transactions you can see there. Depositing money into the bank, withdrawing money from the bank, check given to a person, check received from a person, check dishonored, bank charges. Same model, number of transactions are affected in a bank. Therefore, as a student, whenever you are studying the journal entries, a business is normally connected with the bank. Daily you have to deposit your money and you can withdraw the money and bank charges, check issued, collection, many points are there. Therefore, you have to understand what are the normal or very important banking transactions usually affected in a business. Usually, what are the banking transactions affected in a business? Look here, cash deposited in the bank. You have some money. We cannot keep at home more money. Therefore, what we will do? You will deposit it in a bank. Whenever the money is deposited in the bank, your asset is increasing. That is why bank is debited and your cash is going out from you. Therefore, bank account debited to cash. Debit bank. Then number 2, cash withdrawn by immediately. You need some money. What you will do? You will go to the bank and withdraw the money from the bank. Then whenever you are withdrawing money from the bank, the cash is coming to you. Therefore, cash account debted to bank. Your bank balance is reducing. Number 3, you have many suppliers. You purchased goods from many people. You have to make the payment. Sometimes you are making the payment through a check. That is why payment by check to R. R means a name of person. Therefore, who is the debit? The receiver. Who is receiving the check? R. Therefore, R account debted to bank. You are given a check to a person. Next one, normally bank is doing a number of services to us. Therefore, they are charging some amount from us. That charge is known as bank charges or incidental charges. Bank charges or incidental charges. Bank charges charged by the bank, but it is for us, it is an expense. Therefore, bank charges account debted to bank. Then you received a check from a debtor because you have many credit sales are there, many customers are there. They are coming to purchase cash or credit may be there. Credit means after 3 or 1 month or after 1 week only you will receive the money. Therefore, when a company or an organization is received a check from a debtor, you are not depositing that one. Cash account debted to customer. The next transaction will be that a check you are depositing to the bank. Then what will be the entry? Bank account debted to cash. When check or cash received deposited the bank, the entry will be same. Bank account debted to cash. Then you deposited a check into the bank. That check is dishonored. Maybe some error will be there. There is no sufficient money is there. Anyway, there is an indication from the bank that your deposited check is dishonored. That means again the customer has to pay that amount. Therefore, the customer will be, your asset is increasing. The customer account debted to bank. These are the common transactions which are affecting in a business usually connected with the bank. Thanks.